Hello, my name is Miguel, and today we'll be presenting our investment thesis. Our chosen forecasted event for this assignment is an unexpected surge across all types of goods. For buy and sell recommendation, we recommend buying Woolsworth and selling Wesfarmers during this event. Next slide, please. We believe this is the best course of action because of Woolsworth's strength as a defensive stock in a high inflationary environment. Being in the industry of selling grocery commodities makes it the least susceptible to the downward pressure inflation brings to sales. Woolworths also has the benefit of increasingly secure supply chains with its new opening of the Moorbank distribution center and a very strong household name brand. On the other hand, we recommend selling Wesfarmers due to the due to the exposure of discretionary spending businesses such as Bunnings, digital products, and office products, and others. And now presenting the figures for Woolsworth is Dewey. Okay, next slide.
Yeah,
Thank you.
I want to talk about Woolworth. Woolworth is compelling buy recommendation in our inflation shock scenarios. Starting with their valuations, our DCF model estimate a share price of $44.48 compared to current market price of $41.89, implying about 22% upside. This valuations remains resilient even under higher WACC that show in their sensitivities line chart on the left and on the right we can see steadily increase projected free cash flow to the firm from 2025 to 2032 underlying Google's strong fundamentals. And this one, I'm going to talk about why Woolworths win in an inflationary environment. So from macroeconomics perspective, inflation is shaping consumer behaviors. Households are cutting back on discretionary spending and prioritizing essentials like food. As a supermarket change, Woolworths benefit from inelastic demand, stable food sale, and persistent spending on necessities even when consumer sentiment is low. And on the industry side, Woolworths has clear defensive positioning, its market dominance, operational efficiency, and strong digital expansions give it a competitive edge. This micro and macro strength positions Woolworths to outperform during inflation, making it our top five pick. And Nikki gonna present about sell recommendation for Outlook.
Yep. So our DCF valuation model estimated the Wesfarmer intrinsic value at around $74, while the current market price are slightly above $82, implying a potential of 9.6 downside. This suggests the stock might be slightly overvalued based on the forecasted fundamentals. A surge in a surge in inflation will likely reduce Wesfarmer free cash flow by the increase of the operational costs and lower profit margins, although the depreciations and interest remain stable. Next slide, please. Rising inflation creates a pressure on consumer spending, while Westfarm itself having an increase in operational costs across logistics, wages, and materials. Moreover, the lower consumer confidence also reduced the demand for non-essential goods, putting further pressure on revenue and valuation. In a highly competitive market, Wesfarmers may struggle to raise price without losing customers. However, its investment in digital and omni-channel strategies, along with a focus on value-driven products, could help the cushion of the impact inflation over time. Next, Taidong will continue with the conclusion.
Right. So in conclusion, our research shows that rising inflation is changing the way people spend, and they are focusing more on essential items and cutting back on non-essential goods. Woolworth is well positioned for this shift because it sells everyday products and runs efficiently, with strong and long-term growth. In contrast, Wesfarmers own stores like Kmart and Target, which is rely more on non-essential spending, making it more vulnerable in tough economic times. That's why we would recommend you buying Woolworths and selling Wesfarmers to stay safe and smart in an inflation-driven market. Thank you so much for watching and listening to our presentations.